This is Sherpa Ashley Tison, and today we are reviewing Form 8996. And you are in the right place if you have a captive qualified opportunity fund, or you're an accountant or an advisor that needs help filling it out for clients. If you're an investor, check out my video guide for the 8997 form. You can find that link down in the comments below, or Form 8949, which is going to show you how you're going to ultimately defer your taxes and let the IRS know that you're putting money into a qualified opportunity fund. So IRS Form 8996 is where the magic happens for opportunity zone funds. It's the single form that you actually file with the 8996 in order to self-certify as a qualified opportunity fund. It's really important that you understand that this is only for qualified opportunity funds and not for qualified opportunity zone businesses. So only the fund is going to file this. And what you're going to do is you're going to gather information from the qualified opportunity zone business that you're ultimately going to put into the form. So without further ado, let's get rolling on Form 8996. And it's actually pretty simple. It's amazing that in, the greatest tax incentive legislation ever created was done in roughly 3 pages, and that the actual form that you file with the IRS in order to certify compliance is 4. It's amazing. Now, there's 500 pages of regs that you got to jump into, and they reference other provisions of the tax code, which is why you need to make sure that you got a good professional assisting with this. But the actual form is really simple. So the first thing is that you're going to put the name of the qualified opportunity fund here. So the OZPros QOF LLC, and then the EIN number of whatever that is, your tax identification number for your fund. Once again, this is only for a fund. The qualified opportunity fund is the only one that files Form 8996. Do not file this for a qualified opportunity zone business. The type of taxpayer is either going to be a corporation or a partnership. You got to be either a partnership or a corporation. If you're an LLC with multiple members, you're going to be a partnership. So most folks are going to be filing that partnership box. Is the taxpayer organized for the purpose of investing in qualified opportunity zone property? Yes. So you need to check that, because if you're not, then you're not going to be filing this form because you're not going to qualify. Is this the first period the taxpayer is a qualified opportunity fund? Yes. So this is typically if you've if you were set up prior to 2023, then that's going to check no. But if you've set up your qualified opportunity fund in 2023, then you're going to check yes. If you checked yes, provide the first month in which the fund chose to be a qualified opportunity fund. And that's either going to be, January, February, whenever you put your capital gains into the fund is what you're going to delineate here. So I'm going to put March right here, like we put it back in March of 2023. If you were to put, and I'll kind of walk you through where this is relevant later on down here, because if this were to be July, say, then you're not going to have a first 6-month test. And so you're going to leave these blank. But if it's March, you're going to need to make sure that you complete these provisions right here, because you will have a first 6-month asset test. If this is your first time that you're filing this form and you seeded your fund during March of 2023, more than likely you kept that money in cash until past your first 6-month asset test. And then you typically won't have dropped that cash down to your qualified opportunity zone business until, probably, later on in the year. Certainly you need to have done that prior to December of the next year, because if you don't, then you're going to hit penalties. So if you're watching this video and you've got money sitting in your qualified opportunity fund and it's past December 31st and you set your fund up between January and June 30th of the previous year, you definitely want to drop that money into a qualified opportunity zone business. If you set it up between July 1st and December 31st, then you're going to have till the following June 30th before you got to drop your money down into a qualified opportunity zone business or into property. Now, this is also important, and typically in the previous video that we did, most qualified opportunity funds would not have had an investor divest any of their investment, and so they would end up checking this box, no. But if you had anybody that actually pulled their money out and they had an inclusion event, you're going to check yes. So, and you're going to make sure that you want to attach the addendum to that shows that they actually got rid of a portion of their investment. This is where it gets interesting. This is where the rubber hits the road on what your aggregate amount of money that went into the fund and where you've put that money. Let's say that you had $1 million worth of capital gains and you put $1 million into the fund. That is what the number is going to be in this form 8, and then this line 11. And that's going to be the aggregate amount of the money that you've deposited into the qualified opportunity fund. So this will be $1 million right here. And then if you haven't added any additional cash, that's going to be the same amount in this line 11. Now, if you put like an extra $500,000 in it, so let's say that you put in $1 million in March, but you really had a 1.5 million gain, then this is going to be $1,500,000 as of the end of the year. The big port and the most important piece of this is how much money you've taken from your qualified opportunity fund and you've dropped down to your qualified opportunity zone business. And that's what you're going to put right here, is that you're going to put how much money you've taken from the fund and put into the QOZB. So if you go to this part right here, because this is what you've got to get to, because it says, enter the amount from Part 6, Line 2 for total QOZ property held by the taxpayer on the last day of the first 6-month period. And that's going to be a total of, if you owned property directly from your qualified opportunity fund, that information is going to go here. So if you put money directly into qualified opportunity zone property, and typically the only time that we recommend that people do that is if they're going to be purchasing like a newly constructed opportunity zone asset. So like, let's say that they're buying a fourplex. We've done a bunch of work with FIG, or they're buying a newly constructed, Airbnb that's down on the water, and they are picking that up, and that's the only asset that they're going to own. Then they're going to enter in this owned property value. So they paid $1 million for that fourplex, and they're going to put that right there. And then they're going to identify the census tract number right here. And so you need to make sure that you know where the census tract is. So you're going to have to go to the opportunity zone map, pull the census tract data, pull that information, and you're going to come up with the census tract number, and you're going to put that right here for each census tract that you have property in. This is important because you got to actually allocate it per census tract. That's why they have so many lines here. Whether you own property directly or if you've invested into a qualified opportunity zone business. So if you put this into a qualified opportunity zone business, that's where this goes right here. And so either way, you're going to have to identify the census tract number. And if you own property, or if you invested into either property that's outside of the zone directly, or you invested into a qualified opportunity zone business that has property outside of the zone, then you're going to, it's got this deal right here where you indicate it by all 9s. And so you're going to indicate that with 9s for non-opportunity zone assets. But to the extent that your QOZB is inside of an opportunity zone census tract, you're going to delineate that by census tract here. So let's say 1, 2, 3, 4, 5, 6, 7, 8, 9. And you're then going to show the EIN of the qualified opportunity zone business. So in this case, like our fund invested into an operating boat and RV storage facility down in Port St. Joe, Florida. And so we would put the EIN of that, which is called OZBYS PSJ. So we put the EIN of that, and we invested $500,000 into that QOZB. And so we're going to put $500,000, and that's going to be, so this is the value of the opportunity zone stock or partnership interest held on the last day of the first 6-month period of the tax year apportioned to each qualified opportunity zone. And so you're going to have to allocate that out according to census tract. Now, inside of, if you have one QOZB that has multiple properties in different census tracts, you're then going to delineate that over here. So if you had it in a different census tract, then you're going to put 5, 6, 9, 4, 3, 2, 1. And then you're going to put the EIN of the QOZB. If it's the same one, it's going to be the same EIN. And then you would allocate the amount in accordance with how much is apportioned between those two properties. So if you had, right, so like let's say that we had invested into a qualified opportunity zone business that had a property inside of a, it had two properties, and it had one that was inside of the census tract down in Port St. Joe, and it had another one that was up here in Wadesboro, North Carolina. Then you're going to put the one for Port St. Joe right here, and then you're going to put the one for Wadesboro right here. And if it's roughly, a different percentage, and you basically just need to compute out the percentage that each property is worth. And that's going to go for your investment value. So if you made a total of a $750,000 investment here, and it's apportioned, to this, in this apportionment right here, in this percentage, if it was 50-50, then you'd put 375 and 375. If it's this percentage, right, where it's 25-75, then you would put this 500 and 250,000. And then on here, you're going to show what the owned property value is for the aggregate qualified opportunity zone business and the piece of property that they purchased. So this was just a portion of the money that got invested into this. And the real value that we purchased the property for down at Port St. Joe was $1,500,000. And so we put $1,500,000 here. And then we don't have any leased property. So that's actually property that's getting leased from someone else. And stay tuned, because I'm going to come back to that as to a way that you can make it so that you can actually identify a census tract if you don't own property inside of an opportunity zone. But that is what the owned property value needs to be indicated there. And it's the aggregate property value per census tract. Now, if you were doing this and you were doing it post-July, then you would leave this side blank right here, and you would put this into over here in the investment value over here. So you'd have 500,000 over here, and then you'd have 250,000 delineated per census tract, and then you'd have your own property value over here, and then you'd have the own property value over here. Let's say that building's worth 500,000. And then you leave the lease property value blank if to the extent that you don't actually lease property from somebody else. And because we happened in March, our investments happened in March, we're going to fill out both of these right here. And then we have the 250,000 right here. And you can continue to go down here and just continue this out. It says if additional lines are needed, you can actually attach an addendum to this, because you've got all kinds of property in different census tracts, and that's absolutely okay. And the key thing is that you need to make sure that you're ultimately totaling these up. So in this case, this would be 750,000, and this would be 2 million. That's over here. And then you've got your 6-month test QOZ property. Add part 5, columns B and C. So if you actually had made a census tract, if you had made a direct investment, you would put that up here. And if it was 500K, you would bring that down to here. And then you would total that up for your 1.25 million right here. That's why they actually have another place, to where you're actually adding these up. Now, most people they're going to do either or. I have yet to see a deal where somebody made unless they did it mistakenly, where they've made an investment directly into property from their QOF, and then they made it through a QOZB. Typically, people are either going to make it directly from the QOF, or they're going to make an investment directly into a QOZB. In this case, it would be 750 here for the first 6-month test, and then it would be 750,000 for the second 6-month test. Now, if I had actually put money in during the previous 6 months, so like let's say that I did, in this case, I had $1 million that I put in March, but then I put in another $500,000 in the second half of the year. if I've made an investment into a qualified opportunity zone business, I'm going to delineate that here. And so I've got the 1.5, right? So like, let's say that I've got the 500 and the 250, and then we added another, we picked up another piece of property for that inside of that original QOZ, inside of the original QOZB, but in a different census tract. So this is 8, 5, 4, 3, 2, 1, whatever the census tract is that you're going to pull from the opportunity zone map. And we put that into the same opportunity zone business, which is totally fine. And we put 450,000 of it into property. This is actually not going to be in that column. It's actually going to be over here in this column over here. We put another 450K in. Actually, let's put 500 in. We just put all of it down, and we put it all into property. It just makes for easier math here for myself, who's sometimes arithmetically challenged. You got 750, you got 1.25 million. Look at that. I did it that fast in my head. So we got 1.25 million right there with an aggregate value of the property, because we didn't invest with anybody else, we've got 2.5 million here for the aggregate value of the property. And it's interesting because I think what the IRS is really trying to do here is get information so that they can show which census tracts are actually getting investment and how much the property value is there. This is also somewhere where you're going to, that's going to factor into your substantial improvement relative to the values that you enter into this form. And this is what you're ultimately going to carry down. So you've got your 750K, you got your 1.25 million because we didn't have any that's directly owned. And then those numbers are going to go back up to the front page. So we've got enter the amount from part 6, line 2. Well, I guess if we had $1 million, we're going to need to invest more than that. Well, actually, let's not do that, because let's say we had cash, right? So we put $1 million into the fund, but on our second page, we've only allocated $750,000 during the first 6 months. So we created this in March. We dropped $750,000 into it in March. And so we've got the total assets here, but we've got a remaining amount of cash as of that first 6 months testing date. But if it's held in cash, we get to exclude it, and we get to say, so this is actually the correct one where I need to. So I'm pulling the numbers from the back page and I'm entering them in here. And then we get to just limit the amount that we're testing right here. And so it would be 750,000, because if it's held in cash, we get to exclude it from the calculation, and it's not going to shift, and it's not going to affect us until the next test. So I'm just going to make a note that we put $1 million in March, and then we put in of $500,000. Let's say that we put that in October. So our total amount here for the total tax assets held by the taxpayer the last day of the taxpayer's tax year is $1.5 million. So we go down here to this one, and now we've got 1 point, because we showed that we invested this, right? We had $750,000 invested during the first 6 months, and then we invested another $500,000 by the end. And we may need to, like, once we go back, right, it may show that we actually needed to invest more than that. So if we've got $1,250,000 here, and we've got 1.5 million, we're going to whip out our handy dandy calculator, and we're going to say 125, and we're going to divide that by 1.5 million. And I'm just doing this for your sake, because I could have done that in my head. Easy to get to 83%, right? But what you're gonna do is you're gonna divide these out, and you're gonna compute what the proportionate test was on the first test, and then what the proportionate test was on the second. So we had 83 on the second, plus 1 divided by 2, 91.6%. Wow, man, we squeaked by the hair on our chinny chin on that one. So we add the line, so this would be 1.83. Divide line by 2, and we get 91%. Is line 14 equal to or more than 90%? Yes. Enter 0 on this line, and file this form with your return. So you're going to enter 0 right there. Now, if this had been less, so if we had failed to invest our the remaining balance of this, so like let's say that we still had this $500,000 in there, and we had not done that second one. So on this one, we're going to go ahead and we're going to take this down. We're going to take it to 750 because we couldn't find more stuff to invest into. So if this is 750,000 for that second test, we come back up to here and we change this to, well, I erased the wrong line. So this is 1.5 million and this is 750,000 still. Rut-row Rorge, we're now at 50% here. So when we add these up, we add this together, that's 1 plus 0.5. Now we're dividing that by 2. Oh man, that's not going to be good. 1.5 divided by, and I can do that one in my head. That's 75%. Okay, so now we've got 75% here. Is line 14 equal to or more than 90? No. Rut-row. His fund has failed to maintain the investment standard. Complete part 4 to figure the penalty. Okay, so we know that we've got this penalty right here because we added these up and we came up short. We came up under 90%, and so we checked no. Now we've got to go over and we've got to calculate the penalty. It's really interesting because you start calculating the penalty in month 1, even if you have, if you started in March. So in this case, we started in March. Now, this is also really something that's important to think about because you get to exclude the cash from the testing if it's held in cash as of the first 6 months. And you get to exclude it for the months that you are testing if it's held in cash prior to the 6-month test. So like, let's say that in this one, we had put the money in March, but we didn't invest it into the qualified opportunity zone business until May. And so in this case, we're going to start this as month 1, and we're going to start calculating it as of March. So March becomes month 1 for us. But total assets held on the last day of the month is going to be 0, right? Because we're excluding. And then we're going to do that. So we exclude that by 0. And then total QOZ property, 0. We got 0. Underpayment rate, so divide line. So that's going to be 0 down at the bottom. Month 2, so that's going to be April. We have the same thing that happens. And then month 3 is where we now have invested this because this is May. So this is March. This is April. This is May. So now we have invested that $750,000. So we got the total assets held. We've got to calculate them now because we've invested it, $750K. And then we multiply that by 0.9. That's 675. So it's 675,000. Total QOZ property held on the last day of the month. Because we've invested that down to a QOZB, right? We've hit it. We've got 750,000. So we're good to go. Subtract line 3. If less than 0, enter 0. So we're subtracting this, right? Subtracting line 3 from line 2, and that would be a negative number. So we enter 0. The underpayment rate, we calculate based upon the underpayment rate as of the month. And this is, this is set out in the IRS. Once again, if you need that underpayment schedule, we've got that. We're trying to get that up online. I don't know that it's up online as of the date that we're releasing this video, but reach out to us, drop us a line at OZPros.com, fill out the contact form or schedule a strategy call. And we've got that underpayment rate. We'd be happy to give it to you. We've got it scheduled out. I don't know how far we go back, but it goes back a ways. So you figure out what the underpayment rate. In 2021, the underpayment rate was basically nothing. In 2023, man, it started getting gnarly, like to the 7% range. And so you multiply that. So in this case, we're multiplying line 4 by line 5. So we're going to get a 0 again. And we got a 0. And so then we've got June right here. And so we've got 750,000, and it's basically going to be the same thing. 675K, 750K. and we got a 0 and a 0 and a 0. July is where it gets interesting, because July, unfortunately, because we've invested the first amount into the QOZB, right? It's now, and if we haven't met the test by the end of the year, then we got to go back and calculate from when our first test, right? So when this would have happened. And so we've got $750K, and I guess it depends on when we put the money back into the deal. And we said that we put the additional $500,000 in October. And so for our first 6-month test, right, because we put our thing in March, our first 6-month test actually doesn't hit until the October. So we get to disregard any additional cash. It's really kind of a wacky thing, right? So we're going to still be filling out the same numbers here, right? 675, and this is going to be 750 is what we held, because once again we haven't put money in until October, and we've got 0, 0, and 0. And so well, Fisher, I've got to really think about this, and I actually need to map this out, and I need to walk through this with somebody else. So let's hold off on this, and I'll map it out and walk through this exact example with somebody because as I'm sitting here thinking about it, it's interesting because I don't know that we're going to owe penalties until October, but I gotta think that through. Well, I'm just going to go ahead and do it this way, and then if I need to reshoot it, we'll just sub this one back in. So cut this out and then cut this back in so that we've got this one ready to go. So we're going to do the same thing for August, September, October, November, December. So August is $750K, 675. Total QOZB property is $750K. This is going to be a 0. Number 5 is the underpayment rate. So let's just call it at 6%. We're going to multiply. That's going to be a 0. Multiply and then divide line 6 by 12. That's going to be a 0. September, same thing. 750, 675, 750, 0, 0, 0, 0. Now, October is where it gets interesting, because total assets held on the last day of the month. Now we've got an extra $500,000 that came into the scene, right? And we've got where we put in now where we've got $1.5 million, right? So 1,500,000, and we multiply that by 0.9. 1,500 times 0.9, and that equals 1.35, right? So 1,350,000 right there. Now, the amount of assets that we have as of October, like when we talked about this, is that let's say that we haven't invested any more, and so it's only 750,000, right? Is that now we've got to subtract that out. So we've got 1.35 million minus 750,000. Oop, not 7.5 million. $600,000, right? That is short. So we got $600,000 right here. Okay? And so we take that, right? And we have the underpayment rate right here. So let's say that it's at 5%. So we multiply 600,000 times 5% times 0.05 equals 30,000. And now we divide that by 12 to come up with the monthly rate. So that's $2,500. So this is going to be 30,000. This is going to be 2,500. And if we still, right, if we haven't, if these are basically the same thing, it's going to be the same thing, the numbers from over here. So this is 1,350, 750, 600. And the underpayment rate might change, so you got to pay attention to that, but we're just going to keep going on this example. 30,000, 2,500. Same thing for December. 30,000, 2,500. Okay? Penalty. Add columns A through F of line 7. 2,500, 2,500, 2,500. This is $7,500. Okay? And then enter the total here and on part 3, line 15. So this is going to go back over to here, and we're going to put $7,500 here now. Ouch. So you can see that you really need to pay attention to what the dates are and where you are with respect to how much money you've put into your QOF and whether you've dropped that money down to a qualified opportunity zone business. Because if you don't, it can get really ugly. And this is particularly the case if you put your money in beginning part of the year, because you can imagine that if we had started these calculations way up here, that this number is going to be significantly higher. So this is something for everybody to pay attention to. But one of the things that it kind of is what it is. Unfortunately, if they haven't moved the money from the QOF to the QOZP, there's going to be penalties, and you've got to calculate this. And if you've got questions about how to calculate the penalties, when to start it, when not to go start it, reach out to us. We'd love to set a strategy call, and we'd love to walk through it with you. If you're interested in doing this on a regular basis, we are hitting these calculations, and we're hitting this on the regular during OZ Ascent, and we'd love to have you be a part of that as well. So we've got a number of ways to be able to interact. You can always, once again, drop us a strategy call, drop us a line, and we can set up a strategy call. But we'd love to have you in that weekly Ascent where we talk about just this kind of stuff. And it's a weekly mastermind for folks just like yourself where we talk about all things OZ. And we'd love to have you in there. This is OZ Sherpa Ashley Tison with Form 8996, and we are out.